Today, I'm going to talk to you about a complete framework for evaluating online business acquisitions I created called the 5 Ds of digital deals. And what this is a systematic approach to evaluating digital acquisition opportunities. And each D represents a critical dimension of assessment. It's scored on a scale of 1 to 5, and it creates a deal score that quickly communicates opportunity quality of digital acquisition opportunities. So the framework consists of 5 Ds. It's data, defensibility, dependencies, demand, and deal. And you go through and you grade each acquisition opportunity on a scale of 1 to 5 in each of these 5 dimensions. And so I'm going to go through some of these now together. Hopefully this makes your life a lot easier as a buyer of digital companies. So the first D is data. Essentially, can I trust the numbers when I'm looking at an opportunity? So you're going to be evaluating financial verification, performance metrics, and data integrity. So the first part of this D is financial verification. So you need to have professionalized financials when you're looking to buy a company. If the seller wants a professional value for their company, they need professional financials. And so you want to ask for 3 to 5 years of financial statements, including the P&L or income statement, the balance sheet, and also the cash flow statement. You want tax returns, ideally to match those claim financials. Now, all businesses are going to run personal expenses through their business to try to decrease their tax burden. The P&L should be the actual numbers of the company. And some of those expenses will be personal expenses to decrease the profits, and then they show those sort of fake fudged profits on the tax return. So there will be some variability between what the tax return shows and what the P&L will show after you consider those personal expenses as add backs to the profit, right? So if a company has a business owner where maybe he bought a Porsche through the company as an expense, well, that's not really an expense of an e-commerce company or a digital marketing agency that has all of its clients, abroad and international. And so you'll take that expense of that Porsche and add it back to the profit. So if the company did $500,000 in profits on the P&L and there's $100,000 in Porsche expenses, you add that back to the $500,000, that's really $600,000. So just be aware of that when you're comparing the P&L to the tax returns claimed profits on there. But on top of the financial statements and the tax returns, you want to ask for bank statements so that you can validate that what they're claiming they're making and depositing to their account is actually what they're depositing. Something else you want to look at it on the P&L would be revenue breakdown, and ideally that would be by product type or service type or sales channel type. So if they sell on their Shopify site and they have some wholesale customers, those are broken out so you can see what the revenue was of the Shopify site, what the revenue was of the wholesale customers, and you compare the profitability on those two channels to see if they have an optimum revenue channel mix there. And so something else you want to look at would be working capital requirements, what's needed to run the business, and then what's included in the sale, how much working capital is included, if any. A lot of digital companies don't include any working capital, especially if it's a product-based e-commerce company or Amazon company. They'll typically include some amount of inventory as working capital. Usually it's about a month or 2, 3 months of inventory, and it's negotiable on every deal. But you need to understand how much of that's included and how much you need to bring to the table when you buy a company so you have some cash flow to keep that business operating. And then just understand accounts receivable and accounts payable, and if there's any aging accounts receivable and paying. So performance metrics would be the next thing you want to look at. Monthly recurring revenue versus one-time revenue. What's the customer acquisition cost of that company? What's the lifetime value of a customer once you acquire a customer there? What's that lifetime value to customer acquisition cost ratio? What's the churn rate and retention rate of those clients? Do they buy your service one time, or do they buy your service, every month for 6 months or 12 months, whatever it happens to be? Understand the conversion rates by the traffic source and by the funnel, gross margins, contribution margins, and then just unit economics of that company in general. Traffic and analytics verification is the next section under the first D of data. And you want to look at, ask for full access to the Google Analytics account, the Google Search Console, the Facebook ads account, the TikTok account, all of those accounts you want to take a look at. And, when you're buying a company, this is really your time to make sure that that company is what the seller is claiming it is. So you want to have insights into all their advertising channels, all their analytics, all their platforms to double check that it matches the marketing data that the customer's putting, or that seller's putting out. Asset documentation would be the next section in the first D of data. Make sure that they have domain ownership. They actually own the domain and the website and the IP that they're claiming that they own, things like that. And check tax and compliance records. Make sure they're paying sales tax if they have to pay sales tax, that they're VAT compliance across all the jurisdictions they're selling in, things like that. So red flags in this scenario would be tax returns, again, that don't match the claim financials, either above or below. Those add backs don't make sense. Seller refuses to provide analytics access, if they're trying to hide anything or stop you from seeing, certain things in those accounts that could be a red flag. Sometimes they just want to protect their, their trade secrets and their marketing style and marketing secrets. But sometimes it's, they're trying to hide something. So you have to ferret that out and understand what's going on in each individual case. Look for unexplained revenue spikes or drops. Well, most companies tend to have some seasonality to their business. So there's going to be, obviously, in consumer products, a huge spike during, Black Friday, Cyber Monday, Christmas time, things like that. So some of those revenue spikes and drops could be natural, but just understand if it is natural for the business you're looking at. And then scoring. So scoring here would be 5 would be flawless. They would have complete transparency, all data independently verified, clean books, 3+ years of clean financials and tax returns and professional accounting. 4 would be very good. And a 1 at the very end of that would be unreliable numbers, missing critical information, major red flags. If it's a 1 or a 2, recommend just passing on the deal entirely. A 5, 4, 3, all could be good or at least stable acquisition opportunities. You then want to go to the second D, defensibility. So data and then defensibility. Defensibility essentially is what protects this business from competition and time. You need to evaluate the competitive moats, the market position, and then also the long-term sustainability of the company. So competitive moats would include brand strength, recognition, reputation, customer loyalty, brand equity. You want to inspect any proprietary assets, intellectual property, understand if they have exclusive relationships either with suppliers or partners or distributors, vendors, things like that. Are there any network effects with this business? Does the value increase as more users join, like marketplaces or platforms or communities? Are there any switching costs? Once a client joins your company, pays for your services, is enrolled in your business, are there high costs associated with switching, or the high friction associated with switching to a competitor? Economies of scale, regulatory barriers, and then you want to look at market position, market share within a specific niche or segment. What's the pricing power? Any first mover advantages there? Do they have community engagement? Any thought leadership? Any awards, recognition, or press coverage? All of these things increase their market position and make the company more desirable to a buyer. Are there any digital moats? Do they have any domain authority? Are they ranked high on Google? Are they ranked high on Amazon? Do they have a lot of feedback? Do they have a lot of good feedback and good testimonials, things like that? How's the email list quality? Are their subscribers engaged? Do they have strong open and click rates? How's the revenue model strength? Is it recurring revenue or is it one-time revenue? Do they have any subscription revenue, any membership revenue, any retainers? All of these things increase the predictability of revenue and profitability into the future, which is something that's highly desirable when you're buying any asset, especially a very dynamic online business. And then what's the business model sustainability? Are the products evergreen products or are they fidget spinners? Are they services that are going to be desired 5 or 10 years from now, or is AI going to put that out of business? What's the market maturity? Is it a young market? Is it an aged and stable market? Any maintenance? Do you have to stay, constantly innovating for this business, or is it reliable and stable on its own? So the last thing for this section would be barriers to entry. Are there any high capital requirements or education requirements to get into this business, or can anybody jump into this business and be your competitor tomorrow? Some red flags would be, selling just off the shelf Chinese products, commodity products, no differentiation, no branding. If it's a trend dependent business, right? If it's just a fad product that will have no demand next year. Is it a declining industry with headwinds? Check trends.google.com and look at the overall trend of this business product or business service over the past 5 or 10 years. Is it stable? Is it declining? Has there been a huge spike recently indicating that that's probably a fad product? And if it's just gone up 1,000% over the past year or two, it's likely not going to continue to do that unless it's something crazy like AI that just changes the world and changes all business. But I think you'll look at the search terms for fidget spinner in 2018 or 19 or whatever it was, and look at that spike and look what happened afterwards. You can look at the trends for ice bath has been a big one, or sauna over the past few years, and look how that trend looks. If it spiked up, was there a massive pullback afterwards? Those are things you sort of want to avoid when you're buying a company. Is it easy for competitors to replicate exactly what you're doing? Things like that. So scoring again here, 5 would be flawless, multiple strong moats, dominant niche position, 5-year track record, very difficult to replicate. And on the other side of that would be a 1. Defensibility, it's a commodity off-the-shelf product, declining market, or it recently lost key advantages. Again, 1 and 2, you probably want to pass no matter what the other scores look like. And if it's a 5, 4, or 3, it's either a good, very good, or flawless acquisition. The third D is dependencies. So we covered, data and defensibility, And the third of the 5 Ds is dependencies. What are the single points of failure? You're evaluating concentration risks, any critical vulnerabilities that could disrupt the business, key person risk, platform risk, things like that. Anytime you have any dependency in the company, that is a huge risk. So you want to look at key person risk. What's the seller involvement? How many hours a week do they put into the business? What tasks are they performing that they can't pass off to an employee because they have specialized knowledge or skill sets to do that only? And you're going to have to learn that and carry that on or find somebody to take that over. It's a little bit risky. Are they jumping on calls with all new clients? Are they the face of the company? Are they driving revenue? If so, that is much more difficult to replace than if those things are being done by an existing employee. So not that it can't be a good acquisition. Some people want to buy a business where they can spend their days working in the business. Some people want something to do and want a lifestyle business to own. But if you're looking to buy a business where you don't have to jump in and put 40 or 50 hours a week into the business, you want to look for key person risk. And that doesn't just have to be the owner. That could be the COO or the CFO or whoever it is managing a huge responsibility in that business, because if that person walks away and they're essentially driving the entire operations, you could be in trouble. So you want some diversified responsibility across the company. Also, platform and channel concentration. Do they have single platform dependency, right? Or 100% of the revenue and sales coming from Amazon or from Shopify or from eBay or whatever it is? That's more risky than if the revenue channels were diversified, because if you have 100% of your sales from Shopify and something happens with your payment processor or your website goes down, then you have no other sources of revenue. So again, any single dependencies can be definitely at risk to the acquisition, I would say. Are all the sales coming from organic Google traffic? What happens if Google algorithm changes and hurts your rankings? Are all of your sales coming from Facebook marketing? If Facebook, suspends your account next week, what happens to the sales and revenue of that company? And I've seen this happen before. So, not that these companies with some concentration aren't good acquisitions, but your goal would be to acquire the company and immediately diversify some of those marketing platforms or revenue channels. Now, is there any supplier or vendor risk? Again, if you're buying all of your products from one supplier and that something happens to that supplier, especially if they're international, who knows what's going on in some of these countries, right? It could be government shutdown or war or, crazy stuff happens, right? So ideally you want to have few suppliers or few vendors, even if you're just using one actively and you have 2 or 3 backups where you can quickly switch from one to the other. Should something go wrong, that's obviously better than just relying on one person. What's the customer concentration? Is the top customer responsible for 40% of the revenue of the company? If so, again, that's risky. I had a client I met with just a couple of weeks ago. They had a digital marketing agency and they were doing about $7.5 million in revenue. Their biggest client walked away, and overnight they went from $7.5 million in revenue to like $4.3 million in revenue. And it was a huge disruption to the company. They now lost, 35 or 40% of their revenue and profit. So, if you're a business owner, you have a different perspective. You want to take on every client you possibly can, but when you do, you need to take those profits and quickly try to diversify your clientele and not just, have one giant client driving 40% of your revenue. As a buyer, you want to avoid those situations entirely. So if you're looking at a company to buy and it has, one client that's driving 40 or 50% of the revenue, that would probably be a hard pass unless you're experienced in diversifying clientele and building the marketing pipeline and lead gen services and getting new clients onboarded quickly. All right, look at the tech and infrastructure risk. Again, outdated tech could be dependency, code that's customized that nobody else understands or is sloppy or is outdated or is prone to breaking. Those can all be dependencies that increase risk when you're buying company. Any legal and regulatory dependencies, you don't see any of these as often, but that could be an issue as well. And then operational dependencies. There could be equipment requirements or lease agreements or things like that. So red flags here would be seller is irreplaceable. Business is the person running the business. Avoid that completely. High revenue from any single platform or customer or client or channel. Undocumented processes, SOPs. It's all in the owner's head, things like that. So again, scoring 5 would be flawless, 1 would be poor. So 5 would be fully systematized, highly diversified across all dimensions, seamless transferability, 0 critical dependencies. And a 1 would be critical single points of failure. The seller is irreplaceable, can't transfer the assets easy, and extreme concentration on any of those dimensions. And that leads us to the 4th D, demand. So is the market opportunity real and growing, right? This is evaluating market size, growth trajectory, and then future opportunity. I say this over and over and over again, that a rising tide, raises all ships. A huge portion of the success of a company is due to the success of the overall industry. And so, when you're looking at stocks, let's say as an example to acquire, you want to make sure that your stock is also in a well-performing industry. So right now, AI is doing great. Alternative energy is doing great. The best performing stocks in the entire market right now are those category of companies. And so it's the same thing with online companies. You want to make sure that there's a market demand. We mentioned this a little bit earlier about checking, Google Trends. So what's the market size and growth of the company? The total addressable market. Most markets in the world are large enough for you to have a very successful $3, $5, $10, $20 million company, right? Even this world's smallest markets are typically hundreds and hundreds of millions of dollars or billions of dollars at this point because our economies are so large. But if you had some crazy, I like to make shoes for a specific species of bird. I don't know, something crazy like that. Like that would be an industry that you could never scale to a $10 million business probably. But other than something ridiculous, doesn't matter what category it is, fishing, hunting, beauty, fashion, all of these things are enormous industries. So for the most part, when you're looking at acquiring, $1 million to $20 million companies, the market size is going to be big enough for you to make a good sized business there, but always a great idea to check anyways. There's something else you want to check in demand are customer behavior and trends. So this is the Google Trends data we mentioned earlier. Look at that trends data, understand if there's increasing search, trends or decreasing search trends, if there's growing pains, if there's a shift, like a digital shift moving from offline to online or vice versa. If there's any demographic trends, is the target customer population growing or declining, right? There's a huge, a baby boomer population in our country right now. So medical care, healthcare is a huge industry right now because all of the baby boomers are getting to the age where health issues start to occur more and more. What's the competitive landscape? Is this something where competitors are jumping in and competition is super intense right now? It's very saturated or not? Are there any barriers to entry, pricing dynamics? Take a look at product market fit. Is there a clear value proposition for your company? Does your product or service solve real problems or fulfill a genuine desire in the market? Is there customer satisfaction? Do you have the company have good reviews or bad reviews? Check Trustpilot, Reddit, look at the overall feedback. There's a little bit of nuance there because most of the time as a buyer, when you go buy a product or service, you often don't check the reviews first. You see something online, you see an ad, you buy it, unless it's a big purchase decision. You typically, anything under $100 or whatever that limit is for you, you just buy it without doing any research. And then if you have a bad experience, you go and you post it on the review platform. So sometimes the review platforms are more of a place for, disgruntled customers to express their frustrations. And so it's sort of weighed toward the negative. But overall, you should still see good replies, good feedback. You should see that the company is trying to solve the issues that customers are complaining about and things like that. So just make sure that there's some interaction with clients there, that it's not too bad. You definitely want like above a 4 out of 5 for sure. Ideally, it'd be, at least 4.2, 4.3, 4.4 above for acquisitions there. But, is there economic resilience? So what's the purchase category? Is it a necessity product or is it a luxury product? In times of financial crisis, those luxury products are going to hurt, the revenue is going to fall a lot more than the necessity products. It's like, during recessions, we have, the Dollar Generals type of, the Dollar Trees, those things do really well. Walmart does really well. Louis Vuitton probably suffers during those times and vice versa though. So the next thing you want to look at here in this D is the technology tailwinds or headwinds. Is AI automation impacting that business? Is it going to enhance efficiency or is it going to threaten that business model completely? What's the platform evolution? Are there iOS privacy changes, platform changes, social algorithm shifts, things like that? Any emerging technologies, any, VR, blockchain? Understand what new tech is coming to the market, how that's going to affect the business you're acquiring. A lot of times it doesn't for digital companies, product-based e-commerce companies or Amazon companies. There's not a lot of tech that's going to affect you buying product in the marketplace. But sometimes maybe, if you're looking at software, that software could face some issues in light of AI being, improved over over time. Is there any issue with regulatory or macro environment? Again, this is getting a little bit detailed here, but are there any regulatory trends, favorable regulations or restrictive crackdowns, bills that could hurt or help you? Again, you probably wouldn't see a lot of these, but one good example that we have experienced lately are tariffs. These tariffs are definitely putting some pressure on e-commerce companies, Amazon companies, because so many of the United States products are manufactured in China. So that, is a real life example of something that e-commerce and product-based company owners have been struggling with this entire year. And then are there any growth levers or upside potential? Any untapped channels, right? Do you have any experience running Google ads and this company hasn't yet, expanded into Google ads? They run all their company ads on Facebook or all their ads on TikTok or whatever it is. Can you look for geographic expansion? Is the company only selling in the US? And maybe it's a bathing suit, clothing company, and they sell only in the US and they have, great sales during the spring and summer, and then they slow down during the fall and winter, or maybe expanding to the southern hemisphere in Australia, New Zealand, South America, Central America could sort of, stabilize some of that yearly revenue when it's winter in the northern hemisphere, it's summer in the southern hemisphere. So just think about things like that when you're looking to acquire a company. Is there room for product line expansion? Are they, have they added new products to the lineup? I mean, a great way to expand your company's revenue is to add new products that your existing clients are prone to purchase, right? I think, there's some companies that have done this really well. I think like the Razor wallet company did this recently, where they basically built a brand on selling wallets, but then they'd expanded into wedding bands and protective travel suitcases and energy, battery packs to charge phones and devices. So you have a list of customers. Maybe you're looking at an e-commerce company with 100,000 people in the email list who have purchased previously. Well, think about what else those people would buy. You have a lot of products to expand into. Typically, if you're selling camping gear, there's thousands and thousands of products in camping gear. So if you only have 10 SKUs right now, there's a lot of room for expansion there. So, think about that when you're buying companies. Are they currently upselling or cross-selling their clients on the website or any other way, right? On calls, if their services. Is the pricing optimization? I see a lot of business owners tend to have increasing expenses over time, and they don't increase the price of the products or services in step with the cost, with the expense price increases. There's always some fear as a business owner that if I increase my prices, my customer is going to continue to buy, or the ad's going to perform as well. But you can't have Google and Meta increasing their prices every single year and you not increasing your prices. That causes margin compression and you make less money over time. Your competitors who are raising their prices in lockstep do better and outcompete you, and that business struggles over time. So make sure that the business owner is increasing prices. And if he hasn't and his prices are below market prices, then that might be a good opportunity for you to come in, immediately raise prices and do better with the business. Red flags here would be declining search volume, of course, market interest over the past year, any disruptive technology coming out, any regulatory crackdowns, things like that. So again, 5 is flawless, large and rapidly growing market, strong tailwinds, multiple expansion opportunities, resistant to recession, and tech-enabled growth. And then 1 would be declining market, structural headwinds, fad product losing momentum, shrinking demand, or any major disruption threats in the marketplace. So again, avoid a 1 or 2 here, and anything that's a 3, 4, or 5 is a possibility for acquisition. And the 5th deal is, does the math work for this acquisition? And you're going to evaluate the valuation, the deal structure, the financing, and also the transaction execution. So this is going to be an analysis of the valuation. So look at the EBITDA, the earnings before interest, tax, depreciation, and amortization. It's sort of like the profits of the business, or the SDE, which is you start at basically the EBITDA, the profits of the business, and you add back those personal expenses run through the business that we talked about earlier. So if the company does, $500,000 in EBITDA and there's $100,000 Porsche expense in there, they're now at $600,000 in SDE, seller discretionary earnings. You want to compare that to industry benchmarks. For different sizes of companies, there's different levels of multiples. For a company that's doing $500,000 to $1 million, you'll typically see a 3 to maybe a 4.5 or 5 multiple on that. So you take that profit, that SDE or EBITDA, and you multiply it by, call it a 3, and you get a value. So $500,000 in EBITDA or SDE at a 3 multiple will be a $1.5 million business. Now, does that make sense for that business size and that business category in the market today? Of course, want to look at revenue quality, market comparables, asset valuation floor. Are there any hard assets associated with the company? Most of the time for digital companies, there are almost no hard assets. But if there are any there, definitely evaluate that. If you're looking to buy e-com company, Some e-com companies actually have the machinery and the manufacturing, and they produce their own products. It's not very common, but they're definitely out there. We've definitely sold some of those. So, those will have, real estate leases, or they'll own some real estate, they'll own manufacturing machines and things like that. So, you can evaluate and valuate the company and use some of those hard assets in the valuation. Does the seller have any urgency? Motivated sellers may accept a lower valuation or offer more favorable terms, more seller financing, things like that. The deal structure. So you want to look at, again, overall value, overall price they're asking, and then the structure of the opportunity as well. So a more favorable structure to a buyer could be a better opportunity and could make the deal work. Remember, if you're using a loan to acquire a company and you're paying right now, 10.5 or 11% over 10 years time, that loan is amortized over 10 years, you're adding about 60% to the price you're paying. So if a business owner is willing to seller finance a chunk of that at a favorable, interest rate, then that could increase the viability of this deal. So you want to look at not only the price they're asking, but the deal structure too. Is the seller willing to, hold a note? Will they offer some seller financing? Will they accept earn-out provisions so that you're protected on the downside if something happens to that, the revenue of that company, profitability of that company? Are they including any working capital? Is there any inventory included? All these things count when you're looking to acquire a company. And then, so the valuation, the deal structure. What about the total return and economics of the deal? Do you expect this to be a fast-growing company over time? Do you expect some tailwinds to help grow this? Is the industry growing? All these things factor into your decision. And then financing. Is this company financeable? Or is it something you're going to have to pay cash for, right? You always have to look at your opportunity cost when you're making acquisitions. If you can buy a company using an SBA loan with 10% down, and then you get to save a big chunk of your money for other investments. Maybe you can buy another company. Maybe you can put it in the stock market. Maybe buy a piece of real estate. So a lot of people prefer to put the least amount of their own cash down as possible. Some people don't. Some people like to pay cash. They don't want to go through the hassle of an SBA loan and financing. But these are all things that, if you can get the company eligible for financing, it's an easier acquisition than if you can't. Because at the end of the day, there's not as many people have $2 million in cash or $5 million in cash sitting around that they want to put entirely into a business acquisition, right? It's just riskier to use all your cash for one business investment. That's not a liquid investment. You can't just sell tomorrow like you could in the stock market. So financing compatibility is an important one. And companies that are not eligible for financing are much more difficult to sell, and those sellers generally have to be much more flexible on the terms, offering more seller financing than they would if the company is eligible for SBA financing. So, that just use that in your weighting and think about that. If it's easily financeable, it's a better deal. If it's not easily financeable, could be a much more difficult deal depending on how open that seller is to financing the deal for you. Legal and compliance, you need clean ownership of the company, clear IP ownership, make sure any contracts are signable. There's no litigation history, things like that. A lot of times your due diligence company, your attorney will run these checks for you, and most buyers don't do a lot of the legal and compliance work themselves. Transaction timeline and execution. Is this something you can close reasonably fast, right? You like to get deals done as quickly as possible because time kills all deals. You never know what's going to happen. We had a deal once where, it took me, I had this company on the market for about 6 or 7 months, and we finally found a buyer for it. Not that that's a long time for a company to be on the market, but we found a buyer for this company. We went through the due diligence process and they got funding lined up. And literally the day that we were signing the asset purchase agreement, the agreement to buy the company, the seller of the company ran to the grocery store to get some milk for his wife. He got hit by a truck and was put in a coma for 3 months after that, and the deal fell apart. So you just never know what will happen. Crazy stuff like that happens sometimes. So you want to get the deal done as quickly as reasonably possible. So if the seller doesn't want to close for 6 months, that could be a potential issue. You want to close in, 60 days, 90 days, 120 days if you're using SBA financing at the very most. And scoring on here, again, would be 5, would be flawless. It's below market valuation, buyer favorable terms, clean legal, highly financeable, comprehensive transition plan, and exceptional ROI potential into the future. A 1 would be it's overpriced. There's a poor structure. The owner wants 100% cash at close, no earnout, no seller financing, and could be legal problems or no transition support, things like that. Again, avoid a 1 or a 2. A 3, 4, or 5 would be an opportunity for acquisition, depending on how the company scores in those other 5D dimensions. So again, just going back to the top here, the 5Ds are data, defensibility, dependencies, demand, and deal. Remember, I have this quote here at the top. Remember Warren Buffett's famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price," especially as somebody newer to buying and operating digital companies. You want a company that's already a well-oiled machine and running very smooth and seamless for you into the future. Okay, so let's go back down to the bottom of this framework here. This goes into the scoring system. So a company that scores a 23 to 25 is going to be a unicorn of a deal. It's exceptional on all dimensions. It's a rare find. It's an institutional quality asset. Great company to acquire. 20 to 22 is blue chip. It's a high quality business with strong deal terms, and it's a premium acquisition target. 18 to 19 would be a solid performer. It's a strong business with good terms and an attractive opportunity. 15 to 17 is still a good opportunity, but may require some improvements. Probably more suited for people with a little bit of experience here. 12 to 14 is workable. Definitely for experienced buyers only, experienced, digital marketers or operators of digital companies. It's a little bit of a fixer-upper. And then anything that's, below a 12, I would just say is a hard pass, no matter what the scenario. There's always a better business and a better opportunity out there. Think about Warren Buffett's famous quote. So any score of a 1 is pretty much an automatic high risk and is an elimination no matter what. If it has 2 or more 2s, again, this cannot score better than workable and best to walk away unless you have a lot of experience in the industry. All 4s and 5s, great opportunity. Buy it if you can. So, I'll send you this complete framework. If you just click the link in the description below, I'll send this out to you. No problem at all. You can go through this thing in detail, look at the rest of it. But, not only does this framework help you, sort of remove the subjectivity and look at this with an objective framework, an objective lens. You don't always want to remove the emotion out of the deal, right? When you find what you think is a good deal, you get excited, your emotions flare up, and sometimes you just have sort of that emotional decision or maybe some sunk cost fallacy. Hopefully this helps you step back, identify the company in a very objective way and make a very objective and clear decision. So there is some pattern here, right? So if you have a business that ranks like a 5, a 5, a 4, a 5, but then a 2 on the deal, right? That's a great business, but the seller is asking too much money for it. And it has to make sense financially too. This is a financial acquisition. So that would be something you walk. So there's a few more examples of these here in the worksheet. I'll let you guys go through those in your own time. So that's all I have for you guys today. I appreciate you. I'll see you next time. If you want to catch more videos, I'm sure there's a link right up here to some more videos for you. Have a good one. Bye.